Yeah. So good evening, everyone.
Good evening, ma'am.
Welcome to all the participants joining us from TiE Kerala and various TiE chapters across the globe. Thank you for being part of the Masterclass series 2 of the TiE Women Kerala 2026 program. And today's session is on financial planning, revenue models, and unit economics, an essential topic for every entrepreneur uh, venture. So it's my pleasure to introduce our speaker today, Mr. Roy Varghese, founder and managing partner of Roy Varghese and Associates, investor with the Kerala Angel Network and a charter member of TiE Kerala. With over 4 decades of experience advising startups, multinational corporations, and high growth businesses. He has mentored numerous entrepreneurs and is widely respected for his expertise in financial strategy and business growth. A warm welcome to you, sir.
Thank you.
We are delighted to have you with us today, Roy, sir. And thank you for taking the time to share your insights with the TiE Women Kerala community. And over to you, sir. Once again, a warm welcome to all the participants.
Okay, thank you. Nisha, you want to say something or?
Nisha is there. Huh?
Yes,
Okay.
I'm very much there. Just
Oh,
want
I'm
to
sorry.
just
I
want,
thought.
no, that's okay. Just want
Yeah.
to tell all the participants that you're very privileged to have Roy sir with us. They say numbers never lie, so today you're going to learn what makes your story a success, and Roy sir is the best person to help you with all the numbers. All the best and enjoy this wonderful eventful session by our dear Roy sir. Thank you.
Thank you, Divya and Nisha. As an introduction, I had some research done through Akarsha, who is coordinating this along with Divya. And I came to know that 3/4 of the participants have beginner or basic knowledge of financial matters. 16% has got intermediate knowledge and 11% has got advanced knowledge. So some of the I expect some of the advanced knowledge persons may not be participating. So basically, I'll be going through the very fundamentals of finance for the benefit of those who do not have that knowledge. And this is going to be a roughly an hour session. Normally, in presentations, it is said that 30 minutes is the maximum time you can hold your brain to a subject. So we normally go with a 10, 20, 30 presentation that is 10 slides, font size 20 and 30 minutes. But today, I think I have to stretch it a bit. So I have something like 19, 20 slides. So I request your patience because for some of you, this may be quite a new area. For some of you, it may be knowledgeable, but still, if you get something out of it, it is good. Divya, who will be managing the slides, content slides?
Akarsha will be managing the slides, sir. Yes.
Okay, thank you.
So, shall I start sharing the screen now?
Yeah, you can put the first.
Yeah.
So the topic today is financial planning, revenue models, and unit economics. Please move to the next slide. Can you, okay, is it Can everybody read it, or do you want to make it a little more bigger?
If they're joining from their system, laptop or
Okay, then they
desktop,
can see
they
it.
can.
Okay, okay.
Otherwise,
Okay. At the outset, some housekeeping rules. This is going to be a more an interactive session, so I'm not asking for everybody's microphones to be muted, but please mute your mobiles, as well as if you are attending from your office, if you have a landline or some other things, please mute. And always you are asked free to ask questions. Just put it in the chat box so that Akarsha can pick it and interrupt me. And lastly, if it becomes so boring, I'm sure some of you will doze off, but please, once your microphones are on, please don't snore, because I may be hearing it. So that's it. Let us move to the topic. Next slide, please. So why financial fluency for founders? Because in every business, at some stage for scaling up, you may require external funding. Sometimes it can be in the form of loans. Sometimes it can be in the form of investors coming into your business. So these are finance people, those who are giving you the money, and either it is a loan or as a contribution to your capital. These are all finance people. They look at your financials. They appreciate your business. They appreciate your capability, but they all, at the same time, they look at your financials, which are your balance sheets, your cash flows, your profit and loss accounts. And sometimes you will go and say that, look, my company has this kind of evaluation. So basically, those people are looking at your financials. Secondary, while you are choosing your revenue models, I will explain it. You might have heard a lot about in the jargons like B2C, B2B. I will try to explain it in a very simple way. Suppose you are running a ready-made garment unit, and you may have an online sales, which we call direct to customer, D2C. And then sometimes you may have these garments given to shops, which is you are actually supplying to another business. So we call it business to business, B2B. As well as you may be making different kinds of garments, maybe t-shirts, ladies' dresses, gents' dresses. So which one you want to concentrate? Do you want to make everything, or you want to do only certain things, which depends heavily on the next item, which is unit economics. Because you want to choose between the most profitable item which you may be able to sell. There are two different factors in it. One is the market, whether the market will absorb this, because which is the most the product which has most demand in the market. But if you are making a loss in that product, do you want to continue with that product? So these are some of the decisions which every startup has to make. But this is very dynamic in the sense some seasonal changes may be there, some yearly changes may be there. So constantly you have to look at your unit economics, your revenue models, which will give you the financial data. So in total perspective, you need to know your financials once you get into the business. So the session's agenda today is financial planning, revenue models, and unit economics. And I will delve a little bit on the startup funding also, which is not strictly the topic today. Akasha, we can move to the next slide. Okay. What are these basic financial concepts? If anybody has any questions, please raise your hands. I'll be willing to explain it again. What is CapEx? And what is revenue expenditure? So in a business, you have different kinds of expenses. So you assume again that you are running a software company. So you will lease the business premises, you will furnish it, you will buy your computers or laptops, then you will pay your people the salaries. You may have some cafeteria expenses, you will have internet expenses. So you have different kinds of expenses. What is the difference between these kinds of expenses? Some of them are recurring. Some of them are in the beginning only, but periodically it may happen. Typically, your office furnishing, your office lease is all one-time expenses. But your salaries are recurring. Your internet expenses are recurring. So there are two kinds of expenses in any business. One is the one-time expenses, which we call the capital expenses, or in short form, CapEx. CapEx is nothing but capital expenditure. And revenue expenditure is the payroll, your connectivity charges, your travel charges, your cafeteria charges. And let us move to the old business, which I have mentioned, the garments. So your sewing machines will be capital expenditure, whereas your garment purchase will be your cloth purchase will be your revenue expenditure. So revenue expenditure in other parlance is called operating expenses or OPEX. So CapEx and OPEX, which are two distinct kind of expenses, because the CapEx remains there as an asset for some time, whereas the operating expenses, which is the revenue expenditure, do not remain as an asset there. Today, it may be in the form of cloth. Tomorrow, it may be in the form of garments. Next day, it may be sent out and the dealer will be paying you the money. So there is a movement there. Whereas your sewing machine remains the same. Your premises remain the same. So hope I am clear. Anybody has any questions on CapEx or revenue expenditure? Please use your microphone and free to talk. I would like to run it as a small workshop. So, okay. I got some signals. It is clear. Okay, what is accrued X? Okay. There is a comment that can move fast as well, but I'm trying to, because there is a 3/4 majority of people who want it to be more basic. Okay, I'll try to move a little more faster. Accrual were cash basis. What is this? So while the expenditure is incurred, you will be recording it in your books. Assume that it is a sales. So once the sales invoice is printed and the material is dispatched or the service is sent across internet, you are booking a sale. But are you getting the money immediately? Sometimes it may be a cash delivery. Sometimes it may be a periodical, you are giving him 10 days to pay the money or a month to pay. So expenses, there are two ways of recording expenses. One is accrual basis. Accrual is whenever a liability or an expenditure is created, it is recorded. Cash basis is when you receive the money. So while keeping the books, consistency is required on this. Otherwise, it will give you a distorted view. Because suppose one sales invoice you are booking as on cash basis because somebody has paid it immediately and somebody has paid only after 15 days. So accrue, you cannot book the both. Either you have to book every invoice immediately or you will book only when the money is received. Am I clear, or do you want this to be explained further? Okay. And so consistency is the major factor because business assumes that it's a going concern. It's not stopping today. If it is stopping today, you will wind up everything. So in our parlance, we think that the business is continuing. That is why you are booking an invoice when it is sold, even though the money is received after 15 days. Let us move to the next slide. Okay, this takes us to the profit and loss account. Every business has got a profit and loss account which has two sides. One is an income and the other one is an expense side. There are a couple of things in the income side. Income from operations. It can be sales and services, which is your core revenue. Assume that you are running a food business. So the sale of food will be your core business. What is this other income? Some of the money you would have kept in the bank, that is earning interest. So that is not the income from your core business. That is actually you put some money. It's a sort of I won't call it an investment. I mean, you had some surplus money, the business has put in the bank. So there is a small element of interest which is coming in. Non-business income, what is it? Suppose you had a scooter for distribution of the food products.
What do you think? What are the major effective?
Can you just mute that call? Okay,
Yeah.
suppose you have a scooter which is used in the business and it is becoming old and you are selling it. The purchase price would have been, say, a particular amount, but luckily you got a better amount.
Yes.
So this we call a non-core, non-business income. Because your business income is really the garment sales or the food sales or the internet product sales. Divya, please ask the person to mute.
Sure, sir. Sure. Will do.
Separate pharma industry. Industry specific competitive automobile industry emission models
Please mute the phone. Okay, let me go to the expenses side. You have cost of goods sold and employee cost. These are the major elements in every business. Suppose if it is a manufacturing business, your cost of goods sold may be because the purchases are going to be huge expenditure and your employee cost may be lower. Suppose you are in a software business, your material cost is practically zero other than some of the consumables for the uh, uh, laptops or things like that, which you may be buying computers or something. But your employee cost is going to be your employee cost is going to be the bigger element. Then you have administrative expenses, depreciation, and some of the interest you may be paying to the bank. And I will explain on this depreciation a little more in the coming slides. Move on to the next slide, please. So this is the status of your business on any particular day or year end or whatever it is. So you have liabilities and assets. Let me explain the assets first. Everybody knows building or leasehold premises or lease deposit is an asset because a building you have spent money and it is owned by you, and lease you can get the lease deposit back. Then you have machinery or equipment, and in the case of new age business, it will be computers or whatever it is, internet routers. And then you will have vehicles. What is this intangible? Can anybody explain to me what is intangible? Your knowledge. Some of the people are knowledgeable. Please, if anybody knows what is intangible.
Sir, there's a request to explain the previous slide once again.
Yes, I will go back.
Intangible is kind of your goodwill, the brand name, all these things put together.
Okay, let us go back to the, I'll get back. Let us go back to the old slide. And what, okay, what is the matter? What is the item which I have not explained properly? Can somebody say? Please use your microphone.
Last 2 points like administrative expenses and all.
Okay, administrative expenses are because you have some office expenses like overheads plus okay, I'll give an example. So you have a cafeteria expenditure, which is not a payroll expenditure. You have some printing which is happening in the office. You have some stationery purchase, and you have some travel. All these are expenses which are incurred for administrative purposes, which is not directly the cost of materials you are purchasing or the employee cost. And here I want to make a small distinction. If you are using a small internet connection, we normally say it is administrative expenditure. But you are using a high bandwidth internet connection for your software development, and the end-to-end bandwidth cost may be pretty high because you may have, say, large number of employees who are using it. Then we tend to bring it under the first item, that is the cost of services. Is it clear now? Can I move to the next slide? Okay, go ahead, please. So I asked about intangibles and the answer is good. Thank you. And I will also add, suppose you have developed an IP, intellectual property, over a period. Assume that the IP you have developed has a cost of, say, 10 lakhs. And you think that this IP is valid say for 3 years, because it has a life, because every IP has a life. Somebody else may come out with a new thing, somebody else. So this intangible asset, which is an IP, is apportioned over a period of 3 years only. So that is one of the things. Suppose you have a trademark registered, there is a huge cost incurred for trademark registration. That is an intangible because it's not visible, but you have spent money. So the invisible things on which you have spent money, but you have a value in the business, are the intangibles. Is it clear? Okay, in that case, let's just move to the next item, which is very critical, working capital. The other one, the last item everybody knows, bank and cash. What is working capital? Can somebody explain to me your basic knowledge of working capital?
Working
Please go ahead.
capital means
Louder, please. Money required. I have it. Money required to run day-to-day business. Good, good. So let me just explain. If you are running a food processing business, assume that you are making. So I have set some ground rules, please, of your mobiles, crosstalk, everything, because I'll just get distracted and others will also get distracted. Thank you. So working capital in the case of a food processing unit, you will be buying, assume that you are buying fruits and making it, converting it into jam. So your raw material is basically the food. So after coming, it is brought to the plant, you convert that into pulp. So basically, the raw material, which was the fruit, gets converted to pulp, and then you are adding other ingredients, packing it, doing the quality test, and then sending it to the dealer. Assume that this is the cycle you are going through. So day one, you bought the fruits. Day 2 or day 3, your processing happens and you get the pulp, you add the ingredients. Day 4 or maybe the next day or something, you get the quality done. Then the packing material comes. So the first item was the raw material. The second until it is a finished product, it's a work in progress. Because you are adding your labor, your ingredients, and you are converting these things into a work in progress, which remains maybe certain hours or certain days in the business, and then it moves to a finished product. From a finished product, what do? You sell it to the dealer. So then a sale happens, and then the dealer has to pay you money. So what we call in accounting parlance, you have a receivable from the dealer. So basically it was initially cash or bank, which you used to buy raw material and then move to work in progress, then move to finished goods, then move to sales, and then move to the dealer has to give you money. So there is a cycle. So this cycle is perpetual. It is happening almost every day because every day you are buying fruits and adding. Every day you have work in process. Every day you have finished products. Every day you are selling. Every day you have money to be received. So this is a continuous process which is happening. This requires a lot of money. So this is what is called working capital. Is it clear or do you have any questions? Assume that if it is a software company or a platform. So there also these things happen because you have a continuous cycle. Thank you. And let us move to the liability side. Promoter funds, why have I put it under liability? You will immediately say, this is my money. Then why you are saying that it is a liability? Because every business is different from you. There is a separation between you as a person and the business. Business has to be seen separately from the individual. Individual may be driving the business, or individuals may be a couple of individuals may be driving the business, but you are investing some money into the business. Assume that we are closing the business. You are selling the building, you are selling the equipment, you are selling the vehicles, intangibles, working capital is liquidated, bank and cash. What happens? The promoters get the money back from the business. So the business owes the promoters the money back. Is it clear why we are in accounting parlance, we call the promoters funds, which is capital, as a liability? Second is investors funds. Investors may come and give you money. So they expect returns. So that is also another liability. Profits and retained earnings, because the moment you have more profits, it remains in the business, and the promoters and the investors look for some returns. So the business has to return the profits. So it's again a liability of the business, because business is a standalone entity apart from the promoters. Is that portion clear? If I get thumbs up, I will move. Otherwise, I will explain it again. Very good, very good. Thank you. So then you have external liabilities in the business. Secured debt. What is the secured debt? Because you may borrow from bank or some other person by giving a security. So the building is mortgaged. The working capital, because the working capital is in the business. The banks fund you against building. That is the operating assets, capex. Banks may fund you against capex, which they call the term loan. Banks may fund you against current assets, which is the working capital, which is a huge element in the business, which they call a working capital loan, which normal parlance they call overdraft facility or cash credit or those kinds of things. Then you have unsecured debt. What is it? Unsecured debt is a loan which doesn't have any security. Some of your friends would have given it. Even the promoter would have given some money as a loan, because when the business is good, he can take the loan back. Now, what are these trade payables? Trade payables are, you might have made purchases and it is still to be paid. So there will be some liabilities which are payable. Is the balance sheet portion clear? Can I move ahead? Thank you. Thank you. Next slide, please. Oh, this is a little tricky thing. Book profit were cash profit. Just go through the numbers. You have a sales or service income of 100 lakhs. You have all your expenditure of 70 lakhs. Then you have a depreciation. I said I will explain depreciation in detail, because you have some assets which is losing their value every day by use. Because a computer may be good for 3 years or 5 years. Your car may be good for maybe 10 years, 15 years. Your building may be good for, say, 25 years to 50 years. Some of your machineries may be good for, say, 5 years, 10 years. So there is a replacement value for all these things. Plus, there is a diminishing value in it. So every day the value diminishes because you are using it, and there is a wear and tear for it. So in books, we keep an element of depreciation. Maybe cars are depreciated at 15% per year. So if the car value is 10 lakhs, we make a book entry saying that 1.5 lakhs is the depreciation. But actually, I am not paying any cash out. This is a non-cash expenditure. But I am doing it as a precaution that every business has to account for all its liabilities. So this is a non-cash item. So what happens? You look at the profit of the business. Your sales is 100, your operating expense is 70. And then I have a non-cash item of 20. So in the books, I will say 100 minus 70 minus 20 is 10. That is my book profit. But actually, I will have more cash than with me, because this 20 lakhs was not my cash expenditure. So my cash profit is actually 30 lakhs. So in every business, you have to watch these two things separately. You will have a book profit including depreciation in the books, because for taxation, depreciation is an allowed expenditure. But actually, you will have more cash in the business because this is a non-cash expenditure. And you may require this money after a long time to replenish the asset, buy a new car, buy a new machine, buy a new computer. So your cash flow will be actually better than what is seen in the books. Is this clear? Then I will move to the next slide. Thank you. Thank you. Next slide, please. So I'll get back to the working capital again. So working capital, I said, is a cycle. You have cash or bank in the beginning, then you have work in progress, then you have finished product or services, then you are making a sale, and then receivables are to be collected from the dealer or the thing, and whosoever is buying it. And in the process, you will make some profits. So you can either take the profits out, or you can plow it back into the working capital, because your business will grow, and then the working capital requirement. Initially, assume that you require only 1 lakh. So by the time it becomes work in progress, actually this value of the work in progress is higher, because you have added ingredients, you have bought other things. So work in progress is a higher value. Finished good is still higher value. When it becomes receivable, you have added your profit margin also. So assume that in a business, you are selling directly and collecting the money. That means you are eliminating receivables. So the cycle working capital becomes smaller. If you are eliminating receivables, your cycle becomes smaller. Assume that you block your working capital for a longer time. Your cost of holding the working capital becomes bigger. Assume that your finished goods remains with you for a week. Holding cost is still higher. Assume that your receivables get blocked for 3 months. The cost of holding becomes very prohibitive, because your cash flow is affected. So your profitability can come down. So what is the best way? Compress the working capital as small as possible. Assume that you start day 1 with cash, day 2 and 3 in work in progress, day 4 and 5 in finished service goods or services, 7 and 8 in receivables, and makes collection by 15th day. Your money gets blocked for 15 days. Assume that you are getting it done only over a period of 30 days. Well, you require more money, because every day this cycle has to happen. So the crux of the whole thing is how good you are in managing your working capital. Assume that your working capital cycle is 30 days. And you make a profit of 10%. So in a year, you will turn your working capital 12 times because a month is your cycle. You will rotate it 12 times. So what will be my profit? In each cycle, I make 10% profit. So I will make 10 into 12, 120. Assume that my working capital cycle is 6 months because some of the very large products will require made to customer order and things like that. It is 6 months and the margin is say 30%. So what will you make? 2 turns only of the working capital. So what can happen? Your profit will be 30 into 2, 60. So the trick of the game is move the working capital as fast as possible, compress it smaller. Your business will make profits in multiples. Is this clear or you want some more explanation? Because this working capital management can kill or make your business. I'll explain it once more.
Sir, can you give me example when related to with IT industry?
IT, okay. Suppose you are in services or products?
We are actually into both. We look both.
Okay. Suppose you have a services. Services is basically SaaS or it can be keeping people on a monthly billing rate or outcome-based billing and all those kinds of things. Suppose your receivables are getting paid only once in a month instead of once in a fortnight. Your cash get blocked for double the time. Typically in India, we pay the salaries once in a month. So many of the companies bill once in a month to their parents for SaaS services, parents or customer who is. How efficiently you are able to collect, to compress this cycle. You are starting with money, then you are engaging people, then you are coming out with services or products, and then you are selling it. Suppose you are able to do one transaction, say within 5 days and collect the money instead of one transaction within 30 days and collect the money. Is it clear now?
Yes, sir. Yes, sir. Thank you. Yeah.
Because assume that you make only 10% in the 15-day transaction. In every month, you will make 10 into 2. That is 20. Whereas if you are doing only 1 month, a 3-month transaction, because see, that is where the crux of the issue. In products, it will take more time, so you have to keep higher margins. In services, your cycle is smaller, so you tend to have lower margins. Is it clear from the IT perspective?
Yes, sir. Yes, sir.
Okay. Thank you. Let us move. So once you get into the business, you have to look at your project cost. That's the initial funding. So you assume that I have just put some random numbers. Equity is promoter's contribution, which is capital. So I have put it as just 50 lakhs. And I have assumed that I am borrowing 50 lakhs. Or I am getting an investor for 50 lakhs. And the other side is well explained. You have land, building, equipment, furnishing, other office, and then you have the cyclic working capital. So here the question is, how do I decide how much should be my equity? How much should be my debt? How do I come to the conclusion? How do I come to the conclusion how to finance my business? I know my total cost. It is 100. Whether I should put 30 lakhs and borrow 70 lakhs or get an investor for another 30 lakhs. How do I decide? Anybody with an answer? Let us take a very simple example. You are a salaried employee. You want to buy a car. And the monthly EMI is this much. How do you decide whether I should buy a car of 10 lakhs, 5 lakhs or 15 lakhs?
How
Please,
much I
this
can
is very
return
simple.
back? Return back
Pardon?
based on the return back, how much I can pay. Based on that only, I will take that EMI and all.
Yes, exactly. This is what the business should also do. So let us, we will go back to the profit and loss account and see how much I can service my loan. Assume that I can service the loan, I will resort to debt. If I can't service the loan, what I should do? I must put more of my money or I must bring in my friends or whosoever is willing to put interest-free money along with me. Is this clear? So this is what we call debt to equity ratio. So, or in finance parlance, we call it gearing of the business. Whether you want to gear up the business with your money, with others' money, or a debt. Here the question is, all the startups, I would say, gear it with your money as far as possible. Because the moment somebody else's money is coming in, you are parting your ownership. Which is better to do, parting of ownership or taking a loan? What is the general consensus?
Sir, basically depends upon like which industry you are in.
No, I beg to differ a little. Because as long as you are able to take a loan, because you can repay it and the ownership remains with you. So if you are in high margin business, it's always better that you take the loan because the ownership remains with you. Ownership is more costly than servicing the loan. Because you part with the owner, you are parting a portion of the ownership. So strong, we always say that as long as you can create a debt and service it, that is better. But there are some caveats to it. This is good for a linear model of business. But if you are in an exponential growth model, maybe it is good to finance with other people's money. I'll get back to that area. But this is a traditional business I have mentioned. The ratio of how much, whether I should borrow or whether I should take money from others, depends on your servicing capability. That's all I wanted to tell at this slide. Can we move to the next slide? So this is what I discussed a little bit. Equity versus debt mix, that I have explained. The next is, what is this cap table management? Assume that you are in a high growth industry, exponential growth. Typically, most of the IT products, services, platforms, these are all exponential growth when compared to your traditional food processing or garments, or because you have 10 machines and you have a capacity of producing, say, 5 garments per day. You have a food processing unit where you have certain machinery and the capacity is there. You have to add another capacity. Or take a business trading. You have a facility, you have 2-3 vans, so you have the capacity there. Whereas in some of the new generation IT businesses, the growth is not the earlier business, the 3 businesses which I have mentioned, we call it linear growth. Linear means it grows year on year basis. Whereas in some of the other industries like exponential growth, you have a platform. The platform can accommodate any number of businesses. So your growth is exponential. Here, one question which comes now is cap table management. What is this cap table management? Because in these kinds of business, you will be bringing in external funding from angel investors or private equity or these kinds of things, because it's not a debt. It's a part ownership which you are going to give because you require a lot of money. So track the ownership very cleverly, because if too much money comes in, your ownership is going away. After a 2-3 rounds of money, you may find that you are no more the majority shareholder. So cap table management is one, and then in an exponential growth, just always keep an ESOP pool. Many of you may be knowing what is an ESOP, employee stock option, because some of the key employees you don't want to leave them. So give them shares, maybe 5 to 10%. And dilution across the rounds, I will get into details a little more later. Thank you. Move to the next slide. Choice of entity. This I will go fast. Proprietorship is the typical, when you start, you are a proprietor. But the difficulty with proprietorship is every liability falls onto your all assets. Because if there is a court case, it will go into your home, it will go into your ancestral, your properties, everything. Partnership is more or less the same, but people are joining together, but the liabilities still remain the same. And in an LLP, the liability is a little more diluted, but still the liabilities remain with the partners. Person A and B are in a partnership. Person A creates a blunder in the business. Person B is also responsible for it. That is the crux of the partnership. The benefits are shared. The liabilities are also shared. So in a business which is attracting external money, the preferred mode is private limited company. Because even in an LLP, I've seen some of the applicants to this are LLPs. Even in an LLP, you won't get an external funding because a partnership cannot issue shares. You become a partner only. And no external investor would like to pick up a liability of the partnership. So the preferred mode is private limited company from angel funding, public limited, listed, these are all growth patterns. Let us move to the next slide, please. Any questions here? Any questions on the choice of entity?
Hello, sir. Can you hear me?
Pardon?
Can you hear me?
Yes, please go ahead.
Yeah, sir. We are a company um, developed as private limited because we got an advice that like if we need funding, we should go with it.
Yeah, that's what I
So
said. Thank you. That's what I said.
yeah, and also, sir, actually, when we are working on a startup now, we are completely on a new idea. We may have to pivot, and the maintenance cost is there. So how we
If it
plan?
is a please, if it is not a question immediately related to this, we can have it on separate.
Sure.
Thank you. Let us move to the next slide. Oh, this is a little complicated thing, probably for the beginners, but you need to understand it. Growth trajectory and how margins are built. I have said earlier that there are two kinds of expenses in every business. One is a fixed kind of expenditure, which is capital expenditure. But in revenue expenditure also, there are certain expenses which are fixed. In an office, you have rent. In a factory, you have, assume that the factory is taken on lease, you have rent. Whether you produce, whether you give a service or anything, even if your service is zero, your production is zero, you have to pay the rent. You have certain electric connections which has a minimum load. You have to pay for it. So in expenditure also, there are certain expenditure which are fixed expenditure. You have to incur it whether you do do zero production or 10 lakh production. Similarly, in software development or IT companies, you have certain expenditure irrespective of the billing done from the unit. You have certain expenditure like your rental, your electricity connection. You will be engaging vehicles. There are certain fixed expenditure every month. Then there are variable expenditures. Variable expenditure, because in a garment unit, you are going to buy more and more clothes. You are going to pay more and more wages. Similarly, in IT, you are going to pay more and more wages. You are going to hire more vehicles. You are going to have more expenditure in cafeteria. So there are, within the expenditure, there are two kinds of expenses. One is whether you have production, service, it has to happen. Whereas when the production or services goes up, because today we are producing 5 dresses, tomorrow you are producing 10 dresses, that means I need more garment cloth material. So when the services or the production goes up, my expenditure, which is called variable expenses, go up. So I have fixed expenses and variable expenses. So in every business, if you look at the graph, there is a very stable fixed expenditure. Then this goes up, and then there is a exponential growth category where the yellow line and the blue line is basically the linear growth company. Let us move to the next slide so that this becomes a little more. I will get back to this slide. Okay, I'll get back to that slide a little later. The revenue streams, exponential growth streams are subscription model, transaction usage, licensing. You are all aware, most of the people are aware of it. Marketplace commission, freemium. Freemium, I will give you an example. When Physics Wala started, it was a YouTube only. So he gave YouTube classes free and then monetized it through other offerings. So there was a free offering first, which got monetized later. That's the freemium. Direct sales, one time, these are all things I have explained. Move to the next slide, please. The core economics of one unit. What is this unit economics? Anybody knows it?
Unit economics means cost per single product.
Yes, you are correct. See, a unit is one transaction. In IT, it may be one subscription or customer acquisition or contribution margin shows if that single sale is profitable. Let us get into the numbers. You have a product which is selling at 100 rupees, 1000 rupees average selling cost. Cost of goods sold or cost of services. You can, COGS is normally cost of goods sold. In the case of garments, it is the cloth purchased. In the case of IT services, it is the payroll. Shipping and transaction cost, that is your packing, In the case of IT, it is your internet on which it is going. So your total variable cost is 500. I'm not counting the rent. I'm not counting all the fixed expenses. These are all variable expenses. So I have a contribution that is total revenue minus variable cost, 500. I'm quite comfortable. But this contribution, for how many units I'm able to absorb my fixed cost? Because I have a rent payment. So if I make 0 units, still I have to make the rent payment. So I will be in a huge loss. If I make 50, say 10 units and sell 10 units, my contribution will be, you have seen the contribution is 500 into 10. So it is 5,000. My rent is only 4,000. So I will have a small margin. Assume that I make 20 units. So my profit will be 500 into 20 will be 10,000. My rent is still, my fixed expenditure is still 4,000. So my profit goes up. So this is all what is unit economics. Is it clear? I'm not getting any thumbs up.
Sir, I have a doubt.
Yes.
That means we should uh, um, give the cost in such a manner that at any stage contribution margin should be covered. Like,
Contribution should be able to cover your fixed expenditure. Until, because some stages initially you may not reach there. You will have a loss which you have to fund, but try to reach that stage as early as possible. Otherwise, you will continue to incur losses. Is it clear now?
okay. So, sir, up to what is the time period that can be given for?
It depends on each business. Because the more the time you are burning, you are going to burn more money if you are in losses. So that is where in each product you have to see what is the contribution I will get, whether I can sustain that margin, and what is the numbers I should be selling.
Yes.
You understand me?
So in the case of construction, is there any like for a 6 month period like that, or up to?
I cannot say. Construction is basically you are into contracts and you know the margins upfront. Because when you bid,
No,
it's a what kind
it's a
of construction? Contracts or?
It's a product. It's a product. It's a product actually.
Product means you are delivering it on a IT product on construction?
No. It's a foundation. It's a ready-made foundation.
Okay. In that case, it's each unit is sold. Am I right?
Yeah, sir.
Yeah,
Yes.
it is. So your manufacturing facility has a basic cost.
Yeah.
So
Yes,
your
sir.
margins should be able to cover that. Otherwise, you will continue to make losses.
Okay.
So how many numbers you require to cover the fixed cost? That's the crux of the issue. You understand me?
Okay. That
Thank
has
you.
to be sold, right, sir?
Yeah, it
Monthly
has to be sold
basis,
and
that
money
has to be sold.
collected. Yeah.
Okay.
Okay, go ahead, please. Next slide, please. Okay. This is the slide I wanted you people to understand. Now that you know that there are fixed cost and then variable cost in business. So the fixed cost is in the bottom. One axis is units sold, the other axis is your revenue. So units, irrespective of whether you sell or non-sell, you have your fixed cost. But when the sales goes up, your variable cost also goes up. Can you understand that? There is a variable cost. If you look at the graph below, there is a variable cost shade. So at some point, the sales will cross the yellow line will cross the total cost. That is the break even plus the variable cost. Then you get into profit area. Until then, you will incur a loss. Once you get into profit area, you look at the graph, it widens. Your profits are compounding. This is called break-even analysis, which is closely connected to unit economics. Is this slide clear, or you want more explanation? Because you have some basic cost, which I have explained. Then you have variable cost, and then you have sales. You should be able to cover both. But the more you produce, you will be able to absorb your fixed cost faster. Then you have to absorb your variable cost only. So your profits multiply. Assume that you have a production, you have 10 people in your IT services, and you think that you can deliver, say, 10 lakhs per month. But if they are delivering only 8 lakhs, and if they are delivering 15 lakhs, the profitability will be totally different because your fixed cost on the salary or everything remains the same. Is this slide clear now?
Sir, what was this break even?
Break even is the point where your business starts making profit. These numbers are all irrelevant because we have put some numbers to arrive at the graph. In your business, these numbers may not have, maybe different. Break even is the point where your sales is able to absorb your fixed cost plus your variable cost. Is it clear?
Sir, can you give me one example? If you don't.
Okay, assume that you have 10 lakhs as your fixed cost. Your variable cost per unit is, say, 1 lakh. So every 1 lakh addition, and your sales, assume that your sales is per unit, you are doing a sales of 2 lakhs. So you have a contribution of 50,000 rupees in every unit sold. But that 50,000, how many units you require to absorb the 10 lakhs? You understand me? So you require a lot of that to, so you require 20 units to acquire that, amortize that, or absorb that fixed cost. Because each unit sales will give you half a lakh only. But your fixed cost is 10 lakhs. So you require a lot of units produced or services delivered to absorb that fixed cost. Is it clear now?
Sir, I have a question.
Ah.
So basically, what happens if the fixed cost is flexible? Like, for example, I work in the jewelry industry with gold prices going up and down. The fixed cost per unit is not same.
Yeah, in your case, the gold is the raw material. So it's a variable cost.
Okay. Okay.
And I don't know what are your fixed costs in the industry.
Okay.
Because you may have a place which is paying rent. You may have electric connections. You may have machinery which is used. Or there may be certain expenses which, irrespective of whether you produce 1 unit or 10 units, that's the same.
Okay, got it. Okay.
Yeah.
Thank you.
And at this point, can I move back to the a few slides back? Move back one slide. Let me just please move back. Oh. Please move back the slide back. One more. There was another graph. Oh, this is the last. See, move back. I said move to the Move back. One slide back. One more slide. One more slide. Growth trajectory and how margins are built. So if you look at the exponential growth category, that is the yellow ones, your growth trajectory is very high. If you look at the linear models, that is where I said it's always better for the linear models to take debt and go. For the exponential growth category, you require a lot of money. I'll come, please move fast. Move the slides. Next one. Next one. Okay. The one you have moved, go back one slide. So this is the startup journey. Initially, you will have your idea. You will have your money. And typically, as a joke, we say you will have your, it's not joke, family joins because this guy has a good idea. So you tap into the family funds. And then after some time, you tap into the friends funds. And we jokingly also say that some of the family and friends and the fools also join you. So we call the 3Fs will be there in the initial stage. Next is, after some time, you find that still you are a new generation business and you don't have much fixed assets to go to the bank or get money. So what is the next way out? So you have products and services just launched, maybe beta versions. So you look for angel investment. Who are these angels? Angels are people who come like the traditional guardian angels who are not looking at immediate returns. They are sort of a shelter. They may be able to advise you. They may be able to open doors to your potential clients. They may be able to mentor you. These are all what we call is angels are the protecting thing, but they are looking at returns over a longer period, maybe 5 to 7, 8 years. Next is Series A, because your product or service has attraction. So the venture capitalists, bank loans, all these people look at you because these venture capitals work on a fixed period. They have a fund which is raised for 5 years, 7 years, they have to close it, which means they come in, they fund you, they take a profit out of the valuation and get out. And then you have Series B, IPO, exit. I think most of you people are in the pre-seed, seed, and Series A levels. Since this is not a topic which I always love to explain, and due to time constraints, I will leave it like that. But this is the funding journey. Move to the next slide, please. What the investors expect before they write a check for you? Business plan, business valuation. Business valuation is a very large subject. Then they will look at, business plan means they will look at your financial projections, your credentials, your business valuation. Then they will do a due diligence on your books, tax, payments, your accounts, your compliance with the regulatory authorities, that is your GST returns, your tax returns, your basically your company law compliances, whether if you are a private limited company, and then the legal documentation. That is, they will have a term sheet signed between you saying that this term sheet is valid for 2 months, during which time we will do the due diligence and then we will fund you over a period of 1 year, 2 year, provided you achieve certain landmarks in your turnover, profitability. So this is the normal thing. But beyond all this, I always say that the business plan, business valuation, due diligence, legal documentations are there, but it is basically the founder which the angels are funding. Because the founder, in our experience, most of the businesses which took money have pivoted their business because their original ideas, when the market changes, they pivot. Some of the companies which in Kerala Angel Network, which we have funded, have totally changed their businesses because that ability of the promoter to pivot, the tenacity of the promoter to survive, we call it the fire in the belly, is the key element, 60% in which we look in a startup. The rest of the things will fall in line: business plan, due diligence, business valuation, legal documentation. Everything will fall in line. Next slide, please. Questions, discussions. And I would appreciate general questions. But if it is very specific, I have a next slide in which I have email ID. You can send me the specific questions pertaining very specifically to your company. I will be glad to answer. But general questions and discussions in the this time, it may be better because your specific questions can be addressed to me later. Go ahead, please. I think I am well within the time.
All right. I am Diana from Tesnix. And the startup is actually, we have built it as a private limited company. But how do we do the valuation of my company?
Valuation is a very tricky game. And normally startups try to value their company in comparison with, somebody in California got this valuation, somebody in Silicon Valley got this comparison. We don't buy into that because it is basically the traction with your clients. If you are in early revenue, what is the kind of clientele you are required to acquire? And what is the traction? Traction on customer acquisition.
Okay.
Traction on revenue. And the tenacity of the founder to remain. So these are the first assessments. Valuation comes next. Typically, what we look at is how much money you require over a period of 18 to 24 to 30 months. Because anybody can make a huge projection of the profit and loss account sales, and there are so many approved methods of valuation like discounted cash flow, comparison method, all those things, and come back and say, I have a 50 crore valuation. But what we are looking is, what is your cash requirement? At least from an investor point, that's my first thing. Maybe from an angel network also we do. What is your cash requirement actually? That's first item. Suppose you require, say, X amount of money over a period of 18 to 24. Why this 18 to 24 months? Because that's a testing period also. You may see in startups, there is something called 80-20 rule. 80% may fail, but the failed promoters are better bet for the next startup rather than the successful so we honor the failed promoters much because they gain experience. So 80-20, if time gets, I will recommend you people to read a book called Power Law.
Power Law.
Power Law. The book
Okay.
traces the history of startups, angel networks, private equities, how these things grow and things like that. It's available in, I think, in Amazon. Power Law by the Art of Investing. So you will get to know how we people think about the startups. And 18 to 24 months, because we expect you to get into the next round of funding at least by the 2.5 years.
Okay.
So do a reverse engineering. How much should I dilute now? I would strongly say you dilute only between, if possible, single digit, but a maximum of 15%. This is a typical case, but case to case it may vary, because in a startup journey, I've said there is angel funding, then there is a pre-seed, the next level of funding, then there is a private equity funding. So after 3-4 rounds, you should not become non-promoter.
Okay.
You
But
should not.
who will do this valuation, sir? It's something like
Valuations,
any agency. Okay.
valuation, there are certified valuers, but that we use only for certain company law requirements. For a funding, we will never take a valuation as a basis, because as an investor, it is my prerogative to decide how much I should invest and what value you have. So there is a typical saving. Once in one of the TiE conferences, there is a gentleman called Natarajan, who was Helion India's president, and later on he was the investment chief executive for Ratan Tata Investments. So he was asked by one of us, how do you arrive at valuations? His immediate answer was, Roy, there is no valuation. There is only value in the business.
Valuate the business. Okay.
Value in the business. I look at the
Value
value in the
in the
business, not at the valuations.
Okay.
So
Got it.
valuations, we use these certified valuers. In fact, our offices are also certified valuers, being chartered accountants. But we use it only for company law filings, because when the shares are issued at a premium, at a high value, we have to justify that there is a valuation. So don't take the valuation certificate as a basis for your funding. Nobody will fund you like that. It is basically your business, it is a simple game where you feel that you have a value. Somebody else has to appreciate that you are beautiful and you have a value. It is old Shakespeare saying, the beauty is in the eyes of the beholder. So somebody else has to say that, the investor has to say that you have this valuation. But typically, we don't advise you to dilute beyond a particular level, because you have to go through 2-3 rounds to end up. And you don't, at that stage, you don't want to become a non-promoter, less than 51%.
So
We have
marketing also will do some work on that, right?
Pardon?
We need to market our company, right? More or less.
You need to, I won't say marketing, you need to convince the investor that you have the value.
Okay.
It's not value marketing alone. It is so many other things.
All right.
Okay, I think I have answered. Further questions,
Yes,
please.
thank you, sir.
Yeah.
Good evening, sir. Carolyn this side. Sir, from this competitive perspective, I know that this question is the kind of weird, but think I should ask this question, because when it comes to valuation part, like what all we should, from the competitor's perspective, what all we should add and what all we should not add, because it's a huge, as you mentioned, there's a huge round two, round three, round. So what are things we should take care of from the competitive perspective?
I didn't understand this competitive perspective. Can you
So,
explain what do you mean by?
so we are into this Thai Kerala presentation or presentation deck, right? So when we present something to our audience, like you investors and all, so what all things we should be keeping and what all thing we should not keep? for the initial rounds and all?
Okay. We initially, okay, there is an investment manager there in TiE Kerala, which Divya may be able to connect to you. And what I would say is you have to prepare a business plan and a pitch deck. So most of you would have done the business plan area, that I'm sure. But the pitch deck, I suggest you can search for a template of a pitch deck, which is available. The template's name is Ratan Tata Investment Pitch Deck, because this is a pitch deck template which is used heavily by startups. Because for when people wanted to take money from Ratan Tata, so Ratan Tata's office devised a standard pitch deck. So Ratan Tata startup pitch deck, you can search in the net, and typically that will give you the business. I mean, there are certain elements in it. Carol, if you want, you can connect me directly. I can send you that pitch deck. My email ID is in the next slide.
Okay, so thank you.
Yeah.
Hello, sir. Sir, initially you have mentioned there is one steady one and there is investor based ones also. I mean, the steady one we shouldn't take outside money and all. Could you give me one example for this?
Yeah, if you take the Kerala's businesses houses, assume that some of the very big businesses in Kerala, they have all grown very steadily. But at some stage, I mean, typically, you are basically, if you are food processing, if you take, or your garment business, if you take, these are steady growing industries. Overnight, you cannot increase your capacity of the production. Whereas in some of the IT companies, IT platforms or new generation things, it is the customer acquisition which goes very fast. Take for instance Amazon or GeoMart, those things. You have a platform in which you can accommodate so many lakhs and lakhs of customers with incremental cost increase. So in each transaction, your fees is going up. Whereas in a garment business, you have number of machines, you have number of people, you cannot ramp up that fast. In such a case, it's better that you borrow first and ramp up the business. After reaching a very large size, you go for a VC or a private equity funding, not an angel, because angels are looking at, even though they are angels, they are looking at an exit, say, within 5 to 7 years. In a linear business, you may not get an exit within that time. Sadiq, am I clear to you?
Yes, sir. Sir, how about EdTech?
EdTech, I won't make my comments unless I know in which sector you are. You are B2B or B2C or whatever it is. Which sector are you?
B2C, sir.
B2C is physics wala is in B2C. So was Byju's. So that gives you the answer, I think.
So you mean that we should go with the B2B as well, or it should be B2B to C?
It depends on your business. I don't know your business. Probably we can connect offline through my email ID or whatever it is. And because physics wala, if you look at the monetization, it was a free initially, which was monetized, but he is now moving into physical classes also. You know that.
Yes, sir. Yes.
So it's a mix, but I know a very good business which is B2B, which is in K12, which is doing around 200, 300 crores. So it depends on which sector you are and what is your focus. You have Xylem, You have other things also. It's all each one is a different bucket. Sadiq,
Okay,
you
sir.
can connect offline. Next slide has my email ID.
Sure, sir. The last question. Actually, we started with an initial idea of in the competitive exam, students are feeling too much pressure.
No,
So
this
we
is a
start.
very specific thing. Can you connect me offline?
Yeah, I mean the question was specific. I mean the can I frame it once again? I was about to ask that financial plan.
Yeah, then it is okay.
Yeah. So we have done 70 units and all. So I want to check the market. We get to know that people are paying, but I need to put a financial planning for that. Now you have mentioned that I mean break even and point and all. So how can we just test the market by putting some money? Like how can we do that with a financial projection?
No, if you are able to convince an angel, he may be putting the money, or you have to bootstrap yourself.
Yeah, definitely we can do that. But how to do that projection? Like how you done with that break even before?
Okay, that requires a little more time to explain. I think you can connect me offline. I will try to answer that.
Okay, sir. Thank you.
Good evening, sir. I'm Kala from CDIS.
Okay.
So my question is that uh, what is the finance health of a company which is funded by an angel investor? Like if we are going for more investing, large amount, if some angel investor is ready to fund us, so as an investor, would you prefer to fund in a company which is already invested by an angel investor or a bootstrap one? Like how
We
the
are
investor
open.
will take it?
We are open for anything
No,
because
no,
if,
I'm not asking for you, sir. I'm like
an
in
angel
a
investor.
investor.
As an angel, my answer is generally as an angel investor. Angel investors are never. I mean, we do angel investors do second round, third round before the larger players like VCs or private equities come in. We have cases where we have done the second round.
Sir,
So-
my question is like you have said that it's better to keep bootstrap the company than to go for an investor if you are a steady growth. If you have a steady growth,
Yes.
and in case at present we have a steady growth, and we think that we will have an exponential growth at a stage. So at present, an angel investor is ready to invest on us. So shall we take it, or we shall take a debt and move forward? And like that decision, how can we make that decision? Like
Okay.
to take the debt, or accept the angel investors funding and then go? Or would it be easy that we take the angel investor fund now? Would it be easy for later funding, or we should bootstrap it? Like
See, at this stage, your valuation, I mean, the angel investor, as I understand from you, is coming because he is looking at your exponential growth inflection point. Am I right?
Yeah, yes.
Okay. So be careful with your dilution because at the inflection point, you may be able to attract much more funds. But the trap is you may be in a financial, if you are in a financial trap now, you will have to take this angel investor now. But if you can afford to reach that inflection point on your own,
Okay.
that is better for you. Did I answer you correctly, or?
Yeah, you have answered it
Yes.
partially. Yeah, I think we should take the debt and move. I thought that
Is it a debt or an equity?
angel investor, they are asking for equity.
Okay, and then if you are able to sustain with debt till the inflection point, that calculation, the calculations and everything you have to do. Because the moment you dilute your ownership, part of your ownership is gone.
Okay.
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 Further questions?
But sir, if we take that money, the time period that's required to do that inflation will be reduced.
That's right. Can I suggest you something?
Yes, sir.
Why can't you take it as a convertible note?
Okay. Okay.
Convertible loan.
That's how
And the conversion can be later decided at a valuation to be arrived based on certain parameters. You take the money, there is a conversion which will take after the somewhere near the inflection point. And suppose you achieve certain parameters, this is the conversion value. Did you understand me?
Yeah, I got it.
Yeah, angels normally do such investments also.
Okay, sir.
And regarding your other question, angels always love to piggy ride on other angels because somebody has verified it already. It's a better bet for us.
Okay. So, okay. Got it. Sir.
Sir, hello.
Yes, please.
Yeah, sir, I had a doubt. Suppose we assume a company, a B2B company, and assume we are a software company. We have hardware part, but basically a hybrid product consisting of hardware and software. So assume we are selling the hardware as a one-time purchase to the institutions, maybe 5 lakhs or something. We can assume any cost, and software will be annual subscription. So my question is, of course, we will put a margin on, like we will source the hardware from vendors and we will put a margin and sell to the customers. But our real money comes from the annual subscription of the software. So if that is the case, then how should we actually do the margin, provided we are a B2B business and the number of customers are limited? Assuming the total number of customers in India is almost 700, then our margin should be large enough so that the business can be sustainable, right? So since ours is a software business, the main cost is, as you have said, salaries and other things like marketing and all other things, but main cost is of course going to be salary. So like, how much margin should we put and how should we put that margin? Like in steady state business, we can calculate the point, our inflection point, by like assessing at which, like after we sell this number of units we will be profitable, right? So should we do that kind of calculation in this business also, or should we calculate the margin in some other way?
No, what you have said is correct, because the number of sales point will be your success. Because how much is your percentage of because the more number of installations you have, the more subscriptions you generate. Am I right?
Yes.
So basically, the more number of installations is the key. Then you have inflection on the other side, which is the margin business. Because the other one is traded, you may not have much margins. But that is the cornerstone which you are building your other business. Am I right?
Yeah.
Thank you.
Okay.
Sir, I actually have a small questions. Like, I wanted to develop a SaaS product. Since I have a prototype ready, but I don't have any team or registered company or anything. Like, I'm not able to get a loan. So can I apply for? Can I go to angel investors? Means, is it possible?
I think for KSM has got different schemes under which they finance initially for startups, like product development, initial customer acquisition. You may have to explore that. At this stage, unless you have a small traction, or unless it's a 1 in a million wonderful idea, investor may not be coming through. Okay. Anything else?
Sir, in EdTech, is it better to go with either B2C, B2B, or B2B to C? My confusion.
Unless I know the product lines and things like that, I cannot give an offhand answer. I can
Okay,
connect you to probably another EdTech, very large EdTech company. Probably then you can discuss, because that business aspect is more individual business.
fine. I think the reason you mentioned initially, I mean, both Baiju and Physicswala were B2C. That's why I was
No,
asking.
they ended up in different ways. You remember, you know that. That is why I said.
Okay. I have a concern that, like, if you're initially going with a completely B2B, our brand name won't come out. If suppose they change later, we may not have any
No, that's a
option.
business decision. I would say Byju's was overfueled by money. So they had to go very wild to satisfy the investors. So it all depends how much money you have in the kitty and how much you are forced to take and then perform.
Okay, sir. Thank you.
Anything else? So my email ID is there. If somebody wants to connect with me, I can try to answer your queries or connect you to some other people whom maybe who are better suited to answer your query. Thank you all.
Hello, sir.
Thank you, sir.
Thank you very much, Roy sir, for such an insightful and practical session. And thanks to all the participants, the TiE Kerala chapter as well as from the other chapters of TiE, for your active participation and especially wonderful questions. So we look forward to seeing you in the session which is happening tomorrow on product market fit using AI. Looking forward to welcoming you all there.
Thank you.
Thank
Thank
you.
you, sir.
Bye bye.